Have you ever wondered if your money is truly safe in the bank? We live in an era where trust has become an integral part of our financial institutions. Banks, with their imposing structures and sophisticated systems, project an aura of impenetrable security. We are led to believe that our hard-earned money is nestled safely within their vaults, protected from all forms of risk. But what if I told you that this safety is more of an illusion, a mirage carefully crafted to maintain our faith in these institutions? The truth is, when you deposit your money in a bank, it doesn't just sit there idly. Banks are not merely storage facilities. They are profit-driven entities that use our deposits to generate more wealth. They lend our money to others, charging interest on these loans, and that's how they make their profit. But lending is inherently risky. What happens if the borrowers default on their loans? Well, the banks could lose money, and by extension, so could you. In fact, this very scenario has led to bank failures in the past, causing individuals to lose their deposits. Think about it. Your financial security, your life savings, potentially at risk due to decisions made by the bank, decisions over which you have no control. Now you might be thinking, but what about insurance? Doesn't that protect us? Yes, deposit insurance does exist. However, it typically covers only a fraction of your deposits. Anything above that limit could potentially be lost. And let's not forget about inflation. The value of your money sitting in a bank decreases over time due to inflation. So even if your money is safe, it's not necessarily maintaining its value. So while banks do offer a degree of safety and convenience, they are not without risks. They are businesses, after all, driven by profit, not by the altruistic goal of safeguarding your wealth. Yes, indeed, banks are not as safe as they may seem. Ever consider how much you're paying for the convenience of banking? We live in an era where convenience is king, and banks, like many other businesses, have capitalized on this trend. But just how much are we paying for this convenience? Let's delve into it. Banks are notorious for their various fees and charges. These come in many shapes and sizes, from the mundane ATM fees to the more obscure account maintenance charges. Each time you use an ATM that's not from your bank, you're hit with a fee. It may seem insignificant, a couple of dollars here, a few there, but over time these fees add up, silently eating into your hard-earned savings. Then there are the account maintenance charges. These are fees that your bank charges for the pleasure of keeping your money with them. Again, these might not seem like much on the surface, but when you consider that these fees are being applied to every account, every month, it quickly becomes apparent how much you're really paying for the convenience of banking. And let's not forget the overdraft fees. If you accidentally spend more than what's in your account, you're charged a hefty fee. It's like a punishment for not having enough money, a bitter irony that's hard to swallow. So where do all these fees go? Well, they contribute significantly to a bank's revenue. In fact, banks make billions each year from these charges. Yes, you heard it right, billions. It's a lucrative business model that banks don't want you to know about. After all, who would willingly part with their hard-earned money for the sake of convenience? Now, this isn't to say that all banks are out to get you. There are plenty of banks out there that offer low or even no fee options. But it's crucial to be aware of these fees and to shop around for the best deal. Don't let the convenience of banking blind you to the high cost it can entail. Convenience indeed comes at a price. Scene script. Are you really earning as much interest as you think? Interest rates? They're the shiny carrot that banks dangle in front of us, promising substantial returns on our hard-earned money. But is the carrot as juicy as it appears, or is it just a mirage? Let's delve into the world of banking interest rates, or more specifically, the illusion of high interest. You see, the rates that banks advertise are not always what they seem. They're often presented in annual terms, but the reality can be quite different. You might see a headline rate of, say, 2% per annum, but when you factor in the compounding frequency, the actual interest earned can be less. Now, let's add inflation into the mix. Inflation is the rate at which the general level of prices for goods and services is rising. So, while your money might be growing in the bank, the purchasing power of that money can be eroding at the same time. If the inflation rate is higher than your interest rate, your real return could be negative. And then there's the tax man. Yes, the interest you earn on your savings is considered income and can be subject to tax. Depending on your tax bracket, this can take a significant chunk out of your interest earnings. Lastly, let's not forget about the hidden charges. Some banks may require a minimum balance to earn the advertised interest rate. Fall below this, and you could be hit with low balance fees, effectively eating into your interest. So, when you put all these factors together, you can see how the actual return on your savings can be much lower than the advertised interest rate. It's important to read the fine print and understand the real cost of banking. Interest rates can be a mirage, more illusion than reality. So the next time you're lured by the promise of high interest, remember to look beyond the mirage. Do you know the real cost of your debt? Let's dive into the murky waters of high interest debt. Banks, those seemingly benevolent institutions, have a knack for making money, but here's the kicker. They often do so on the back of your debt. Think about it, when you take out a loan or swipe that credit card, you're not just borrowing money, you're signing up for a future obligation, and that obligation comes with a price tag: interest. Now, this isn't inherently bad. Banks need to make a profit too, and interest is one way they do it. But the problem arises when that interest rate is high. High-interest debt is like a ravenous beast, constantly gnawing away at your financial health. The more you owe, the more interest you pay, and the beast grows bigger. Before you know it, you're stuck in a vicious cycle, constantly trying to feed the beast while your finances dwindle. Credit cards are a prime example. They're convenient, sure, but they often carry high interest rates. If you're not careful, you can easily find yourself in over your head. The minimum payments become a tempting option, but they're a trap. You're essentially just paying off the interest and barely making a dent in the actual debt. Loans aren't much better. Whether it's for a car, a house, or an education, loans can saddle you with years, even decades of debt. And with high interest rates, that debt can balloon into a mountain that feels impossible to climb. But there's a light at the end of the tunnel. By understanding the dangers of high-interest debt, you can make informed decisions. You can shop around for lower interest rates, make more than the minimum payments, and prioritize paying off high-interest debt first. Remember, debt is a tool. It's like a hammer. Used wisely, it can help you build your financial house, but wield it carelessly, and you can end up smashing your financial future to bits. So be smart, be savvy, and most importantly, be aware. Remember, debt is a tool. Use it wisely or it can become a trap. Do you know how powerful financial literacy can be? Let's journey together into the realm of financial wisdom, where the power to protect and grow your wealth lies in your hands. Financial literacy, in its simplest form, is the understanding of how money works. It's the knowledge of how to earn, manage, save, invest, and donate money effectively. Sounds straightforward, right? But what if I told you that this basic understanding can be the shield that protects you from the numerous banking pitfalls and traps? Imagine navigating through a labyrinth, with every twist and turn presenting a new financial decision. Without a map, it's easy to get lost or fall into a trap. However, equipped with the map of financial literacy, you can confidently stride through, making informed decisions that protect and grow your wealth. Understanding the ins and outs of banking is like holding a torch that lights your path. It empowers you to discern between the mirage of high interest rates and the reality of hidden fees. It helps you recognize the illusion of safety banks often portray and the high cost of convenience they charge. But it doesn't stop there. Financial literacy also equips you with the knowledge to make your money work for you. It helps you comprehend the power of compound interest, the benefits of diversified investments, and the importance of starting to save early. So how do you acquire this power? Begin with the basics. Learn about budgeting, saving, and managing debt. Then explore more complex topics like investments, taxes, and retirement planning. There's a wealth of resources available, from books to online courses, podcasts, and webinars. Your journey towards financial literacy might seem daunting, but remember, every step you take is a step towards financial independence. It's a step towards taking control of your money rather than letting it control you. Financial literacy is power. Equip yourself with it, and you'll be less likely to fall prey to banking pitfalls. Embrace this power. Let it guide you through your financial journey, helping you make informed decisions that lead to a prosperous future.